Good morning, everyone, and welcome to the morning market review. My name is Russell Shaw, I'm a senior market specialist at FXCM. Today is Wednesday, it's the 8th of March. My email address rshaw@fxcm.com. Just going to go ahead and bring up the high risk investment warning. Can I just confirm that you guys can hear me, see the screen, and are you getting a camera shot as well? Just let me know. Yeah, okay, excellent. Thanks, Matthijs. All right, just going to bring up the market commentaries disclaimer. And we'll take a look at the markets in terms of the testimony last night. The testimony last night was exceptionally hawkish, more hawkish than the market anticipated, with the really higher for longer theme. It's just higher for longer and faster being the general theme. And it makes for an exceptionally tough markets. This is one of the toughest markets I've seen for a long time. Here's our references: MarketScope and TradingView. Let's just bring up the TradingView. I want to just show you the 2-year yield. The 2-year yield is on the short end of the yield curve. It's generally a good reflection of monetary policy. And this vertical dashed line here is the date when we had the last non-farm payroll. If you guys recall the last non-farm payroll, we had that blowout figure of 517,000. We did a live trade there. And when the number came out, I was very surprised, and I thought it's probably attributable to seasonal factors. We'll see on this Friday if that's the case or not. We're going to do a live trade this Friday as well, so I've put the link into the chat, and everybody's welcome to register for that if you'd like. But you can see that since the that blowout figure, it's really influenced the government 2-year bond, and it's really pushed up between the 3rd of Feb and today. We also had the inflation numbers, and the inflation numbers are very high compared to target, and that's also pushed up the US 2 yield, very much a reflection of the Fed's thinking and monetary policy. And this chart over here is the dollar. It's really pushed the dollar up as well. And then we've got the correlation between the two, and this is a daily correlation. It's at an exceptionally strong 94%. So the dollar really being influenced by monetary policy at the moment, and the fact that it's been influenced by monetary policy really reflects just the jump yesterday because of the testimony between the Senate Banking Commission. It was very hawkish indeed. And what I want to say is that it puts a lot of pressure now on the non-farm payroll. So if we get a non-farm payroll that beats expectations, I think that we're going to see the dollar really fly, and that's going to influence the trading on the non-farm payroll. It's going to make for an exceptionally volatile Friday. So I'm quite nervous about that, and we're just going to have to see what the print is. And then next Tuesday we have the CPI. We're getting the consumer price index. Now the CPI in of itself is very important, but what I want us to keep an eye on is the median. So I just want to bring up the median CPI just for all of us to take a look at. And the median CPI here is really a good proxy for the sticky stuff, the inflation in the economy that's really resilient to the monetary policy. And you can see the last CPI that we had actually ticked up. We had a tick up here in median inflation, and that really set the tone for the rest of the month, didn't it? As we saw that 2-year yield really just move in that northeasterly direction with hardly a break. And you can see that next Tuesday is going to become an exceptionally important data point as well. So last week, I beg pardon, last night's or yesterday's testimony now puts a huge amount of pressure on non-farm payroll this Friday and puts a huge amount of pressure on the CPI release coming on the 14th of March, which is, I believe, next Tuesday. And then this median CPI is calculated by the Federal Reserve of Cleveland. You can see over here, it takes a couple of days for the Cleveland Fed to release the median CPI. So we'll keep an eye on it. But if we don't see any moderation here, then that higher for longer and faster really becomes something that we need to be concerned about, because the time value of money is going to be affected by that. So just bear with me. I need to show the mathematics here for the time value of money, because it's really what's driving the market at the moment. And please bear with me. We have to try and understand it. So there's a formula. We all should have learned it sort of at high school, and it says the future value. So it's the compounding formula. Future value equals your present value. Okay. 1 plus, and I'm going to put R, I'm not going to put I, I'm going to put R for the required rate of return, and that's to the power of your compounding periods, which we'll put as T, okay? But let's just make this simple. Let's take out the exponent, and let's just rearrange the formula. And the formula, when we rearrange it, looks like this. Present value equals future value, okay, divided by 1 plus R, okay? Now, this R here, this guy, this is where yield sits. So inside R, we've got the required rate of return would be compensation for interest. It'd be compensation for inflation. It'd be compensation for risk on the markets that we're trading. So this is a whole lot of compensation sits in this term here. And at the moment, it's moving up. Okay, it's moving up. So if it's moving up, it's going to put pressure on the present value. It's going to put pressure on the present value to move down. Why doesn't an increase in interest rates put pressure on the present value down? It's because it's sitting inverse. It's sitting, so think about it this way. If we put sort of present value over 1, okay, just bear with me here. Present value over 1. So you can see present value is a numerator. Okay, present value is a numerator, and then you've got future value, which is a numerator as well. So present value would be proportional, would be correlated positively to future value. But because interest rates is a denominator, it's a inverse correlation. I hope that makes sense. Because it's sitting as a denominator and it's moving up, it's going to put pressure on the numerators. So what I'm trying to say is, okay, that we've now entered into an environment where there is potential faster, for higher, and all of this kind of makes it much less. Let me say it a different way. Makes it trickier to trade. And what we can see is, if we take a look at the US dollar, okay, if we take a look at the US dollar, it's no longer trending down. Okay, the US dollar now has made a higher peak here. Okay, so we had a peak, trough, lower peak, lower trough over here. So that's putting that's the greenback coming down. That's important because the greenback is effectively an instrument of safety. In other words, there was money that was coming out of safety, and if money was coming out of safety, it was moving into risk. The fact that was moving into risk bode well for the stock markets. Well, now we don't have an uptrend just yet, but the downtrend has ended because we no longer have these series of lower peaks, lower troughs. What we have now is a higher peak. So we can actually relabel it as follows. Okay, we can take these out, and what we can do is we can put in trough, and we can put in peak. And now it becomes very interesting. What is the trajectory of the greenback? Because remember, the greenback is effectively a instrument of safety. As the interest rates come out, money potentially rotates towards safety. Okay, so now do we get a pullback and then a movement up? Well, that would be quite an indictment in terms of risk sentiment. It would say that there is a risk off sentiment rather than a risk on sentiment. That's a big change up from the first month of 2023. The other way that we can see this going is like this. Okay, and then the downtrend resumes. So right now, guess what? We're sitting right in the middle of no man's land because we don't have a dollar trend to play with. We've got effectively just two reference points, a trough and a peak. What I can see is that the RSI has peaked above 50, and that's on the bullish side. Now, if we go through to an instrument like the DAX, okay, you can see exactly the ramifications for sitting in no man's land. And let's just bring this to the DAX. Is that we're sitting in the middle of a rectangle. We're in the middle of a trading range. It tried to break above that trading range, but it failed. And I think what's going to happen now is that the market probably drifts till Friday and tries to get some sort of direction from that non-farm payroll. The question is it going to be another blowout figure from the non-farm payroll, or does it come in a little softer? The markets would welcome the non-farm payroll coming in a little softer than expected, and then we could attribute everything from that 570,000 to seasonal factors. But you know, that's that is a big sort of capital I, capital F, if we get something that is less than expected. The economists are probably expecting somewhere between 200 and 225,000 jobs that are going to be created. If we get another blowout figure, then I'm afraid we're probably going to see this heading towards the support level. And if it heads towards the support level, we'll see the dollar moving in that northeasterly direction. If we go through to our zone analysis here, you can see that we've actually slipped back into this neutral area. So it's not surprising. We're caught in this trading range, and the zones are reflecting that we're back into this no man's land. So the markets are as tough as I've ever seen them. The idea here is there was at some stage a moderation of inflation, and all of a sudden it's kind of kicked up again, and we have to see if that kick up is temporary or if it's something that's more sustained. And if it's more sustained, well, then the Fed is going to go at the moment, there's sort of on the fence, 25 or 50 basis points for this month, 25 or 50 basis points. At the moment, it's still 25, but the non-farm payroll can really kick that over to 50 basis points. And if it kicks it over to that 50 basis points, then we'll be in a situation where that time value of money really starts pulling the present value down. And if it starts pulling the present value down, well, then we're going to have a flight to safety. A flight to safety is money rotating back into the dollar. And you can see that we've already lost that downtrend in the dollar. So very, very tough markets indeed. We're going to do our crypto minute in a few moments. I've got everything down on my list. If there's any questions here, please go ahead and type in your questions. Any questions, go ahead and type in those questions. Otherwise, what we'll do is we'll conclude at this point, and then in the next few moments, we'll cross over to the crypto minute. All right, nothing coming in. So let's conclude at this point. Please join me in the next few moments. We'll go through onto our crypto minute. Thanks very much, guys.